So, hello everyone, I'm Kian Mahmoudpour. I will be with you in the first part of chapter 3. As you know, because of COVID-19, we still have to present the content virtually, but we do our best to make you understand this chapter. Before I start, I would like to take this moment to appreciate Professor Zارعی for being so helpful and supportive. Thank you very much. Well, in the first part of chapter 3, I'm going to talk about some of the concepts and principles in accounting and link them to the adjustments and adjusting entries. So let's start. On this page, we have adjusting entries. One step in financial statements preparation is a trial balance that we completely talked about it in the last chapter, chapter 2. To measure income, businesses must bring up to date their records at the end of the accounting period. This process is called adjusting the books, and it requires special journal entries that's called adjusting entries. I think about nearly we have 6 journal entries that we will explain it in the next pages. This chapter talks about and focuses on the adjustments that are needed to measure income in accounting. In accounting, we have some concepts and principles to guide the measurement of income. Chief among, we can mention accrual accounting, we can mention accounting period, revenue principle, and matching principle. That I'm going to talk about it now. On the next page, we have accrual accounting versus cash basis accounting. Look, there are 2 ways to do accounting. The first one is accrual accounting that records the effect of each transaction as it occurs. And the second one is cash basis accounting that records only cash receipts and cash payments, and it ignores receivables, payable, and even depreciation. The word depreciation, we will explain it in the next pages. But for now, just remember that under the cash basis accounting, we ignore all of the receivables, all of the payables, and depreciation. And usually most of the companies and businesses use the accrual accounting, and only the small businesses and small companies like retailers use the cash basis accounting. If I want to bring an example for you, for example, imagine one company purchased $2,000 office supplies for its company. Under the accrual accounting, we record the office supplies $2,000 on the debit side, and accounts payable $2,000 on the credit side. But under the cash basis accounting, we ignore this transaction because cash basis accounting ignores all receivables, all payables, and depreciation. And in this transaction, we have payables. So we ignore this transaction. Or another example, imagine that one company performed a service revenue, for example, $5,000, and the revenue earned, but still we didn't collected any cash. In this transaction, we will write accounts receivable $5,000 on the debit side and service revenue $5,000 on the credit side. But in accrual accounting, under the accrual accounting, but under the cash basis accounting, exactly like the last example and instance that I told you, we ignored this transaction. And another point I have to mention that in cash basis accounting, we would record all expenses, all cash payments like an expense and not like an asset. And I know, unfortunately, this is a faulty accounting, but it is obligatory. And for example, for the office supplies, look, when we say something in assets in accounting, for example, office supplies, in the last chapter we remember that it has three features. The first one is that thing has future benefit to the company. And the second one is based on the past event, we have the right to use it. And the third one is its value can be measured in terms of currency. In this situation and three features, we can say something is asset in accounting. And office supplies is asset, all we know in accounting. But under the cash basis accounting, we will treat it as an expense, unfortunately. Another point is cash basis records only cash receipts and cash payments. And in the cash basis, cash receipts are treated as revenues and cash payments are treated as expenses. If I want to bring another example, for example, one company purchased a building and paid cash, for example, $5,000. Under the accrual accounting, we have building $5,000 on the debit side and cash $5,000 on the credit side. But under the cash basis accounting, cash payments are treated as expenses. So we have building expense $5,000 expenses on the debit side and cash $5,000 on the credit side. And this is the versus between accrual accounting and cash basis accounting. On the next page and another page, we have accounting period. The only way to know for certain how successfully a business has operated is liquidation. What is liquidation? Liquidation means a company closes its doors, sell all assets, pay all liabilities, and give any cash left over to the owners. This part of going out of the business and companies is liquidation. But it's not practical and usual to measure income in this way. Instead, the businesses and companies need periodic reports on their affairs. And accountants slice time into small segments and small parts and prepare financial statements for specific periods. Usually, the basic accounting period is for 1 year. And all businesses prepare annual financial statements. Somehow it's obligatory for them. For many large companies, I think in the last survey it was 60%. The annual accounting period runs the calendar year. I mean, it was from January 1 through December 31. Other companies that it is nearly about 40% use a fiscal year. What is fiscal year? Fiscal year means that this period which ends on the date other than December 31, and it starts at the date other than January 1. And usually companies can prepare financial statements for interim periods, so monthly statements are common. But most of our discussion is accounting principle is for one annual accounting period, for 1 year. But it can be possible and it can be happen that companies and businesses use interim periods. For example, for 2 months, for 4 months, for semi-annual event. For example, I mean 6 months. It is all happen and it can be possible. The next one is the revenue principle. The revenue principle tells accountants 2 important items. The first one is when to record revenue, that is when to make a journal entry, and the second one is the amount of revenue to record. About this first one, the revenue principle says to record revenue when it has been earned, but not before and after, exactly when it has been earned. In most cases, revenue is earned when the businesses has delivered a good or perform a service to a customer. The company and businesses has done everything required by the sale agreement, including transferring the item to the customer. So in this time, we can identify the revenue and record it. And when we say record it in the accounting, it means that we should make a journal entry. We can make a journal entry, journal record in the record in the journal, entry in the journal. So, but about the second item, I have to say that, for example, the revenue principle says to record revenue for the cash value of the item transferred to a customer. For example, let me bring an example. Suppose that to obtain a new client, one company, for example, Qatar Airways, for the cut rate price of, for example, $500, sell the ticket. But ordinarily, this company, I mean Qatar Airways, have charged $600 for this service. You think how much revenue should this company record? Exactly, the true answer is $500. Why? Because that was the value of the transaction. And the Qatar Airways will not receive $600. It was $500. So that is not the amount of revenue to record. So this is the amount of revenue to record for the businesses and companies. On the next page, we have the matching principle. The matching principle says about expenses and revenues, or usually expenses. The matching principle guides accounting for expenses. Remind that expenses, different expenses, such as we have rent expense, utilities expense, advertising expense, and so on. These are the costs of operating businesses. And expenses are the costs of assets used up even and liabilities incurred to earn revenue. The matching principle even directs accountants to two important items. The first one is identify all expenses incurred during the period and measure the expenses. And the second one is match all expenses against all revenues during the period. And to match all expenses against all revenues means to subtract expenses from revenues, as we did it and do it in the income statement. And the purpose is to compute net income or net loss. So in income statements, our result will be net income or net loss. There is a natural link between some of the revenues, and some of the expenses. For example, most of our examples was about Gagel and e-travel on the last chapter. So here I will bring Gagel and e-travel example. For example, Gagel and e-travel may pay sales commissions to employees who sell the travel agency service. This is a kind of instance. Or another thing, for example, cost of goods sold. Of course, for the proprietorship company, cost of goods sold, I know, still we didn't mention it. But for another company, forget this example. Other expenses are not so easy to link to sales. For example, Gagel and e-travel's monthly rent expenses occurs regardless of the revenues earned that month. The matching principle says to identify those expenses with a particular time period, such as a month or year. And Gagel and e-travel will record rent expense each month based on the lease agreement. And this is how the Gagel also pays monthly salaries to some of the employees. And this is the matching principle. So that was the first part of chapter 3. I hope you enjoyed. My dear friend Daniel will explain another part. I mean the second part of chapter 3. Thank you very much. Thank you for your attention.
Thank you, Kian, for your explanation and lecture. It was acceptable, and I hope you guys, all of you, are ready for the next part, which we officially are going to start our adjustments. The first adjustment is prepaid expenses. We say that prepaid expenses are advance payments of expenses, just like prepaid rent and prepaid insurance. And I'm sure you already remember that I explained all of this to you in the last chapter, which is chapter 2. Let's demonstrate for prepaid rent. Suppose Gagel and e-travel prepays 3 months of his rent on April 1st, 2000x5. If the lease specifies a monthly rental of 1,000, the entry to record the payment is, so for 3 months we have $3,000 because for a monthly rental is 1,000. So for 3 months it will be 3,000. So this will be our entry for 1st April. Prepaid rent is 3,000 debit because it's an asset and it decreases. And for cash, because we paid, so it decreases and it's an asset. So we credit by the amount of $3,000. So it says here that 3,000 is not the amount to report for prepaid rent on the balance sheet at April 30. The reason is only 1 month passed and we've already reported 3,000, but it's not true because only 1 month passed. And this is the whole, the $3,000 is for 3 months, but only 1 month passed. So in order to do an adjusting entry, it says here that at April 30, prepaid rent should be decreased for the amount of the asset that has been used up. So in other words, in this 1 month period, we use our asset and it became an expense. So our asset decreases and our expense increases because we consumed it by the amount of $1,000 because only 1 month passed. So this is our adjusting entry. On April 30th, the rent expense will be 1/3 of the whole amount, which is 3,000. Will be 1,000 debit because our expenses increases. And for prepaid rent, it decreases because it's an asset and it becomes expense. We consumed it by the amount of $1,000. And these are the references that is useful in our statements. After posting prepaid rent and rent expense, show current ending balances. These two are the key accounts for this entry. For assets, which is prepaid rent, on April 1st, we paid 3,000, and then we subtracted 1,000 because of our adjusting entry, and the balance amount will be 2,000 for 2 months. And as for expenses, which is rent expense, the adjusting entry was 1,000. It was debited because expenses should be debited if they increase. It's based on accounting equation. So the balance amount will be $1,000. This diagram here may help you understand a bit more. The correct asset amount is 2,000 because only 2 months remaining. We have already passed a month. And the correct expense amount will be 1,000. So if we sum these two, the total accounted for will be 3,000, as for the first of the period, the beginning of our period. The next adjusting entry will be for supplies. This is an example. On April 2nd, Gillen paid $700 for office supplies. So this will be our entry for this for our April 2nd. We debited supplies for $700 because we purchased supplies and it increases, it's an asset. And for cash, since we paid, it decreases, it's an asset. So we credit this amount. We credit $700 for cash. But just like the other one, Gillen April 30th balance sheet should not report supplies of $700 because during this period, we used our supplies for our business. During April, Gillen used supplies to conduct business. So they became expenses. Our assets became expenses because we used them. The cost of the supplies used becomes supplies expense. It's obvious. To measure supplies expense, it counts the supplies on hand at the end of April. So in order to calculate the amount of the supplies that we used, we have to do this here. The cost of the asset available is $700. We purchased them at the beginning of our period, and the cost of the assets and in the end of the period was $400. If we subtract this amount from our $700, the remaining will be $300, which means this is the cost of the asset that used. It's the expense during this period. So the adjusting entry for April 30 will be this: supplies expense, $300 debit because it's an expense and it increases, and our supplies decreases because it's an asset, so we credit this amount. We credit $300. This is the adjusting entry for supplies. These two are the key accounts for this entry. For assets, we have supplies, and in the first of the period, we bought 700 supplies, and then we subtracted this 300 because it was expense. We used our asset, so the remaining will be 400. This is the balance amount of our account. And for expenses, we had supplies expense. On the April 30, which is our adjusting entry, we debited $300. So the balance amount will be 300 itself. This diagram helps you. The correct asset amount is 400 at the end of the period. It's the remaining amount of our supplies. And for the correct expense amount is 300. This is the amount that we used during our period. So the total accounted for will be $700. This is an example for further comprehension. It says that at the beginning of the month, supplies were $5,000. And during the month, the company purchased $7,000 of supplies. At the month's end, $3,000 of supplies were still on hand. There are three requirements. The first one says that what was the cost of supplies used during the month, and where is the item reported? Well, since it's an expense, we will report it in the income statement. All expenses should be reported in the income statement. But how do you calculate the amount? We use this diagram here. The beginning balance was $5,000, as it says here. Supplies were $5,000. And we add some purchases. We sum the purchases amount, which is $7,000. If we sum these two, the supplies available for us will be $12,000. And if we subtract the amount that remains in the end of the period, supplies on hand, the remaining amount will be $9,000. The expense, the supplies that we used during this period. This is the T account for supplies. We had 5,000 at the beginning, then we purchased 7,000, and then we used 9,000 here. So the remaining balance will be 3,000. The next requirement says that what is the ending balance of supplies? It was 3,000. Where did the item report? It reports in the, as you all know, it reports in the balance sheet. Well, it's obvious. And the third requirement says that make the adjusting entry to update the supplies account at the end of the month. So this will be our adjusting entry. Supplies expense 9,000 debit because it decreases, and our supplies are 9,000 credit because it decreases. We used our supplies and they became expense. They became supplies expense. And for the next entry, which is very important, I hope you all have your full attention, is the depreciation. This is an interesting statement. It says that, as one accountant said, all assets but land are on the march to the junkyard because they decline in usefulness. It's a fact. So this decline is an expense. We call this decline an expense. And accountants spread the cost of the plant asset over its useful life. So in other words, we have some cost for a plant asset. If we divide it, we spread it over its useful life, this allocation of cost is called depreciation. Suppose that on April 3rd, Gillen purchased furniture on account for $16,500 and made this journal entry. This is our entry for April 3rd. We purchased furniture, so it's an asset and it increases, so we debit this amount. And as for accounts payable, because we purchased on account, so our liability increases, so we have to credit this amount. We credit $16,500. This is our adjusting, and this is our entry for the first of the period, the beginning of the period. And then let's calculate the depreciation. Gillen believes the furniture will remain useful for 5 years, so we have to divide this amount over 5 years, and will be worthless at the end. One way to compute depreciation is to divide the cost of the asset, which is $16,500, by its expected useful life for 5 years. So if we divide this amount by 5 years, it will be $3,300, which means for every year, we have to calculate this amount, $3,300 worth of depreciation. This method is called the straight line method. There are many methods, but the easiest one, which we'll explain to you, is the straight line method. But for depreciation for month is $275. Why? Because if we divide $3,300 by 12 months, the remaining amount will be $275 per month. For every month, it will be $275. For every year, it will be $3,300. In this page, I'm going to explain the accumulated depreciation account. But first, let's just see how is the adjusting entry. For April 3rd, we debit depreciation expense for furniture because it's an expense and it increases. So we have to debit by this amount, $275. And for credit, this is our account, accumulated depreciation for furniture, for $275. You might also suspect that why didn't we credited our furniture account itself? Well, in order to explain it to you more, the accumulated depreciation is credited instead of the furniture account because it's helpful to keep the original cost in the furniture account. So you could say that it's a replacement for our furniture account. We don't have any business with our furniture account itself, but we have business with our accumulated depreciation. The accumulated depreciation account holds the sum of all depreciation recorded for the asset. Well, it's true. In a period, many depreciation happens, so our accumulated depreciation holds all our depreciations. It holds the sum of all our depreciations. Now let's talk about accumulated depreciation a bit more. It says here that accumulated depreciation is a contra asset, which means an asset account with a normal credit balance. We all know that all asset accounts have normal debit balance, but this one is completely different. It has normal credit balance. This is why we call it a contra account. And it has two main characteristics. The first one is that a contra account follows a companion account. And the second one is that a contra account's normal balance, it could be debit or credit, is opposite that of the companion. So the companion account for this example will be furniture account. So after we post the depreciation entry, this is the accounts, the T accounts of our individual company. For assets, for our normal asset, which is furniture, we purchased $16,500. We have no business with this account. We'll leave it be. But for contra asset, which is a replacement for our normal asset, it is called accumulated depreciation for furniture. We credited $275 on the April 30 for our entry, for our adjustment entry. And as for our expenses, we debited $275 because it's an expense and it increases. Another important term for this part is book value. And since it's a contra account, the balance of accumulated depreciation is subtracted from furniture. So in other words, if we subtract the balance of our accumulated depreciation from the furniture, the remaining amount, the resulting net amount of our asset is called the book value. And it follows for furniture in this part. The book value for our plant asset, which is furniture, is here. The furniture, $16,500, we purchased it. And then if we subtract our accumulated depreciation, which is a contra asset, it is subtracted by the amount of $275. The remaining amount, the net amount of our asset, which is called book value, is $16,225. This is called the book value of our furniture. Let's do another example for further comprehension. Suppose Gillen also owns a building that costs 48 grand with annual depreciation of $2,400. It's obvious because we divided 48 grand by 20 years, so the amount will be $2,400. The amount of depreciation for 1 month will be $200. This is the calculation. We divided $2,400 by 12 months. This is the adjusting entry. On April 30, the depreciation expense for building will be debited for this amount, $200, because it's an expense. And for accumulated depreciation, which is for building, it's in the contra account. We're going to credit $200 because it's a contra asset. And this here is for the book value. We have plant assets, furniture and building. For furniture, we said that we purchased $16,500, and after we subtracted the accumulated depreciation, the remaining amount was $16,225. And as for building, which was 48 grand, we accumulate the depreciation, we subtract the accumulated depreciation for this amount. So the remaining amount, which is the book value, is $47,800. So the plant asset net is the sum of these two, which is $64,025. The next adjustment entry will be for accrued expenses. It says here that businesses often have expenses before they pay them. It's obvious. Many organizations and companies have some expenses that they usually pay them before it happens. Before they pay them, it happens, the expense. Consider an employee's salary. It's obvious. Gillen's salary expense grows as the employees work, so the expense is set to accrue. In other words, when our employees work, the expense will be accumulated. So it's not wise to do a weekly journal, to make weekly journal entries. We have to update it, of course, but in order to do that, it would be a waste of time if we do it weekly. So instead, we have to wait until the end of the period. I'm going to explain it how it's done. For salary expense, suppose that Gillen pays her employee a monthly salary of $1,900, half on the 15th and the other half on the last day of the month. This is our calendar. So the first half will be on Friday and the second half will be on Saturday, which is a weekend. But it says here, to illustrate the salary accrual, assume that if either payday falls on a weekend, Gillen pays the following Monday. So in other words, the payment will be in the next month because it's 30th and it's Saturday. So if we pay it on the Monday, it will be on the next period, on the next month. And this is kind of problem because we all know that every expense or revenue should be referred to its period. We can't postpone it. It's not possible. It's against the concept and rules of accounting. So anyway, this will be the following entry for April 15th. The salary expense will be $950 debited because it's an expense, and our cash amount decreases because it's an asset. We pay it. So we credit this amount, and this is our T account for salary expense. And then here comes the second half of month amount of $950 that we will pay on May, on the next month. So Gillen must accrue salary expense for the second half of April. At April 30, Gillen makes an adjusted entry as follows. So we have to make an entry before the month ends. This will be our entry, our adjusting entry. And on April 30, the salary expense will be $950. The other half we debited, and our salary payable, which is a liability because you haven't paid it, is $950 credit to accrue salary expense. This is our adjusting entry for this situation. These two are the T accounts for this entry. For salary expense, on April 15, we had $950 first half, and the second half was paid on the next month, but because of the situation I explained it to you, we can't postpone the entry. So we have no choice but to make our entry in the end of our period, at the end of our April, which is April 30. And for salary payable, we credited this amount, $950. This is another problem for better understanding of our adjustment. Weekly salaries for a 5-day work week total $3,500 payable on a Friday. This month, November 30, falls on a Tuesday. So this amount is only for 5 days. But it says that it falls on a Tuesday for 2 days past out of 5 days. So in order to make the entry, this is how we're gonna do it. The salary expense, we're gonna do this calculation, $3,500 multiplied 2 divided by 5, because it was 2 days out of 5. It's Monday, Tuesday, only 2 days. And these are the references. And so the salary expense will be debited for this amount because it's an expense and it increases. And our salary payable will be credited for this amount because it's a liability and it increases. And the next adjustment, which is adjustment 5, will be accrued revenue. This one is pretty similar to our accrued expenses. Businesses also earn revenue before they receive cash. It happens a lot. I'm sure you already know that. This calls for an accrued revenue, which is a revenue that has been earned but not yet collected in cash. So it happened, our revenue happened, we have earned it, but we haven't collected cash yet. So this example shows you better. Assume that Gillen eTravel is hired on April 15 to perform travel services for a company. Under this agreement, Gillen will earn $500 monthly. This is for a month. During April, Gillen will earn half of the month fee for $250 because our agency, Gillen eTravel, was hired on the half of the month. So only half of the fee is earned. For work, April 50 through April 30, only half of our month. On April 30, Gillen makes the following adjusting entry to accrue the revenue earned during April 15 through 30. This is our adjusting entry for this situation. Accounts receivable will be debited for this amount, $250, because only half of the month has passed. So we have to do this calculation. And as for service revenue, it's a revenue in increases, so we credit this amount. We credit $250. This is a very important point for you, so I hope you all recognize it well and remember it. All accrued revenues are accounted for similarity. Debit a receivable and credit a revenue. It's a code, so you can remember it easily. For accrued revenues, this is our rule. Debit a receivable and credit a revenue easily. And this was my part for this lecture. Only one more adjustment remains. So now my dear friend Sama will continue the rest. Thank you for your attention. Good luck.
Hello guys, hope you're doing well and everything goes on track with you. I'm Zandi and I'm with you with the next part of the chapter. First, I want to thank dear Kian and dear Daniel for their explanation. First, I want to talk about unearned revenue. Then we have an example which includes the whole chapter. And then we have adjusted trial balance. And then some ethical issues in accrual accounting. First, in unearned revenue. Some businesses collect cash from customers in advance. Receiving cash before earning it creates a liability called unearned revenue. And the company owes a product or a service to the customers. And only when the job completed, will the business earn the revenue. For example, Intercorporation engaged Gillen to prove travel services, agreeing to pay her $450 monthly beginning immediately. As you can see, for the entry, it happened at April 20th, and the accounts are cash and unearned service revenue. As I said, unearned service revenue is a liability. When we want to increase a liability, we should credit it. As you can see here, we credit unearned service revenue on the T account for $450, and it is collected revenue in advance. Here is another example. The April 30 trial balance lists unearned service revenue with a $450. As I said at the last part, we want to, the month has 30 days. So we want to divide it into 3 10 days. The first one, the next one, and the last one. So Gillen will earn 1/3, so the amount should be 150. As you can see here, unearned service revenue is 150, and service revenue is 150. To record service revenue that was collected in advance. And you can see their T accounts with their balances. Here is another example about our university and our college, which says that consider the tuition you pay for your college or university. That one semester tuition costs $1,500 that you make a single payment upfront. As you can see, we have entries in our books and in our colleagues' books. As you can see, at the start of the semester, the entry should be prepaid tuition and cash for $1,500. And at the next part, at the end of the semester, you can see another entry, which is tuition expense and prepared tuition. Pay attention to this part. This is an adjusting entry. Adjusting entries may have 3 conditions or maybe one of them, at least one of them. The first one is that it should be at the end of the semester. And the next one part of the entry should be revenue or expense. And we make no entry for cash. We don't have any cash accounts for adjusting entries. And then you can see in our colleagues' books, not mine, my colleagues' books, you can see at the start of the semester, it is cash and unearned tuition revenue, which is collected revenue in advance. And then at the end of the semester, which is unearned tuition revenue and tuition revenue, both of them 1,500 to record tuition revenue that was collected in advance. Here we have something which is abbreviated all the chapter in this. which is about prepairs and accruals. For prepairs, cash transactions come first. Prepared expenses, first we want to talk about prepared expenses. It says that pay cash and record an assets. And the entry is prepared rent and cash. And later, record an expense and decrease the assets, which is rent expense and prepared rent, as you can see here. On this part, we have unearned revenue. For unearned revenue is received cash and record a liability. We should record a liability, which is cash and unearned service revenue. And later, we should have unearned service revenue and service revenue. We should record the revenue and decrease the liability which was created at the before it was created. And then for accruals, cash transactions come later. First, we have for accrued expense, we have accrue an expense and the related payable, which is salary expense and salary payable. As you can see, it is here. And then later, pay cash and decrease the related payable, which is salary payable and cash. And for accrued revenue, we have accrue a revenue and the related receivable, which is interest receivable and interest revenue. As you can see, later we have the cash accounts and interest receivable. Here we have an example, the whole example that I was talked about it is here. Here it's about Giggle Travel Agency and panel A, we want to talk about the transactions which the company had. We have transactions A to F. We have prepared rent expired $1,000, then supplies on hand $400, and then depreciation on furniture $950, and then some others which I want to explain it on the next slide. As you can see here it is all the entries for this transaction, A to F. For the first one, we had prepared rent expired $1,000. So the entry is rent expense and prepared rent. And the next one says that supplies on hand $400. So it should be supplies expense and supplies. Both of them, the supplies expense is increased and supplies decreased. And for transaction C, we had depreciation on furniture $275. As you can see, depreciation expense furniture and accumulated depreciation furniture, it should be credit. And the first one, depreciation expense furniture, it increased and accumulated depreciation furniture decreased for $275. And then on transaction D, we had the transaction on the last slide, which says that accrued salary expense, which is $950. So the entry should be salary expense and salary payable. Both of them increase. When we want to increase a liability, we should credit it. On the next transaction, we have accrued service revenue $250. As you can see here, $250. Both of the accounts should be increased. Accounts payable and service revenue to accrue service revenue. And then the last transaction says that unearned service revenue that was collected in advance and now has been earned $150. So the entry is unearned service revenue and service revenue. Look at that part for the transactions, which was transaction B. We had supplies on hand $400. Our available supplies is $700, and supplies on hand is $400. So our supplies expense should be $300, as you can see here. And here it is all the T accounts which are involved in our example, which was assets, liabilities, and owner's equity accounts. For example, for cash we had, for assets we had cash, accounts receivable, supplies, prepared rent, furniture, and accumulated depreciation furniture, which goes to the balance sheets. And you can see all the accounts. For liabilities, we have accounts payable, salary payable, and unearned service revenue that I said before. It's create a liability. I'm in this part. Unearned service revenue in our liability columns. Now I want to talk about the adjusted trial balance. A useful step in preparing financial statement is to list all the accounts along with their adjusted balances on an adjusted trial balance. The account's title and the trial balance are copied directly from the trial balance. The two adjustment columns show the adjustment debits and credits. And then the adjusted trial balance columns give the adjusted accounts balances. Each amount in these columns is computed by combining the trial balance amount plus or minus the adjustments. As you can see here, you can see the adjusted trial balance. When we want to create each financial statement, we should pay attention to some parts. The heading and the body of the statements. The heading of the statements, which on the first line, we should write the name of the company, which here it is Gagelen e-Travel. And on the next part, on the next line, we should say that it is what we want to create, what we want to prepare. If it is income statements, balance sheet, adjusted trial balance, which one? Here we want to prepare adjusted trial balance, so we should write a preparation of adjusted trial balance. And on the third line, you can see the date or the period which we create the financial statement, which is at April 30th, 2005. As you can see, we had three columns: trial balance, this column I mean, and adjustments, and then adjusted trial balance. As you can see, for example, for accounts receivable, in trial balance, we have $2,020 and $250. And in adjustments on A entry, the first one, which was 250, we should add this to that 2,250. So it gives us 2,500, which is in our adjusted trial balance. We can have more than two adjustments for an account. For example, you can look at service revenue. We have $7,000 in trial balance, but in adjustments, as you can see, in adjustments E and F, we have 250 and 150. We should add this to that 7,000, as you can see here. So it gives us $7,400. And you can prepare all the accounts like this. And after all, we have a balance which total debit should equal to total credits. But look at that part, which is I wrote balance sheet. What does balance sheet mean? Balance sheet is another financial statement which includes assets, liabilities, and owner's equity. And for statements of owner's equity, we just have capital and withdrawals. And for the next part, which is income statements, we have just revenue and other expenses, which we have it. We prepare income statements to determine the income. We have the revenue, and we have all the expenses. And you can see the net income equals $3,525. This net income goes to the statements of owner's equity. As you can see on the next slides, which is statements of owner's equity. As we said at the first line, the name of the company, then the name of the statements which we are preparing it, and then the period or the date, which for preparing the statements of owner equity, we have months ended 30/2005. As you can see, Gagel capital in April 1st was 31,250. And then we should add net income. Which net income? In the last statements which we prepared. And then we should minus withdrawals. We had withdrawals, DT accounts. And then we have Gagel capital April 30th, 2005, which goes to the balance sheet. To compute ending capital, we prepare balance sheet, or we can say for computing, we can say it is a statement of owner equity. But now for balance sheet, we have assets, liabilities, and owner's equity. As you can see, total sides on the right side and the left side should be equal. Both of them are 45,925. As you can see, we put the Gagel capital, which we had it on the last page, so we should put it on this statement. As I said, for adjustment entries should have at least one of these conditions. It should have adjusting entries are made only at the end of the period. As I said, the date should be at the end of the period. And then adjusting entries shouldn't affect cash. And then all adjusting entries, debit or credit, at least one income statements, it should be revenue or expense, and one balance sheet. It should be assets or liability. Here we have some tips that I talked to you before. It was about the financial statements, which we had. It was really important when we prepare it. We should have the heading and the of the statements. On the heading, the first line, we have name of the company. Then on the second line, we have the name of the statement, which is income, statements of owner equity, balance sheet, or so on. And then the date or period covered by the statement, which is April 30th, 2005, or March ended April 30th, 2005. And then the body of the statements as we see it on the last pages. Here we have some ethical issues in accrual accounting. Accountants, like all business areas, should be honest. Adjusting entries are often used to commit fraud because judgment is involved. And accrual accounting provides opportunities for unethical accounting. It's related to our personality. If you are ethical, if you are honest to your work, to your personal life, which one? And it is important for accounts to prepare accurate and complete financial statements because people rely on their data and on their decision. And thanks for your attention, guys. My presentation is over, and I hope to see you soon on the next video. Thanks. Bye.
Thank you, Sama, for your explanation. It was very nice. And I also thank all of you for your explanations. Thank you.
Many thanks to my dear friends Daniel and Sama. Great job. And thank you everyone for your attention. I hope you enjoyed this chapter. And also I hope our presentation has been useful. In the next session and in the next chapter, we are going to talk about complete the accounting cycle and worksheet. And also you can see our email addresses here. If you have any question about this chapter or last chapters, you can ask us, you can ask us and we will reply. Thank you and goodbye until the next session. Bye-bye.